Well, this week we've seen a flurry of financial reform activity from Washington to Wall Street. The Justice Department has now opened a criminal investigation of Goldman Sachs, looking into mortgage security deals it arranged. Meantime, about 6,000 protesters rallied on Wall Street as part of a day of action. All of this took place in the context of debate on the first pass of financial regulation reform. Joe Krier, president of Krier Wealth Management, back here on the morning show to connect the dots. Before we get to reform, let's talk Goldman Sachs. Some interesting nuances there.
Oh, yeah, and I think this is all connected. You know, Goldman Sachs was at the center of a lot of what was going on because it was creative financing that helped the real estate bubble get going, and that's part of what reform is targeting. So for the feds to go after Goldman Sachs was kind of a natural thing, particularly because there was some people in there that got very rich off of the fact that the mortgage mess collapsed. So it was natural. However, Goldman Sachs is a source of a lot of things like secretary treasuries and a lot of government officials and an awful lot of campaign funding for both sides of the aisle.
Politics certainly does make for some strange bedfellows.
Oh, absolutely.
So let's talk about this financial crisis. Basically, we got there because too much cheap credit was extended. And the obvious implication in going forward is that credit has to be more expensive and it has to be more difficult to get. Yet you have the lobbyists who are out there right now, and they're saying, okay, well, we need these loopholes. That would just mitigate the whole financial reform issue.
Mm-hmm. Yeah, it's a tough thing, and you know, I always push for simplicity whenever we talk about legislation. So, you know, if we can make these mortgages less complicated, straightforward, so you know what you're getting, then we're going in the right direction. The problem is that the big banks would issue a mortgage, then they would split it up and create other types of investments, derivatives, and other things based on those, and it would just get so complicated that people would kind of lose track of where the real path of dollars is back to the good old American householder.
So let's look at the financial regulation for Wall Street bankers and brokers. Curb the $500 trillion derivatives market. What's that mean?
Yeah, well, and this gets back to people taking those mortgages, slicing and dicing them, and placing bets on either side of them, and it's just grown out of control. It started out, by the way, as a way for a farmer to guarantee a price at the end of the season, and it just kind of blew up from there, became, I guess you could say, Las Vegas on Wall Street. But then they do want to also cap the size of big banks, which I doubt that that's going to go through the way it was stated. And they want to create a payback or bailout fund, which is another item that seems to be floating off the table right now as we speak.
Now let's get to what really impacts you and me. I'm not a Wall Street banker. I'm not a financier. I'm not a captain of finance. The only thing that I guess I really need to care about and know about is the Consumer Protection Bureau.
Right. And you know, consumers do need protection in this area. There was too many complicated products. People got mortgages that they didn't understand. So we need clear information going to consumers. National Complaints Center, you know, an Office of Financial Literacy and Education. And, you know, one of the keys here is that there's plenty of laws out there, but there was sets of laws in 8 or 9 different departments, and they want to tie it all together. Think about Homeland Security when they tied all the different security agencies together. That's what they really want to do with financial reform. And, you know, there's some good and bad that'll come out of this.
But I got to ask you, is this too much, too little, too late? It's like when the banks were told, okay, you have to go ahead and you have to notify your consumers in a timely fashion when you're going to raise their interest rates. So before the new rules and regs went into effect, what did all the banks do? They went and raked us over the coals.
Yep, and that's how it seems to always work, you know, and it's better to do something than to do nothing, as long as that something in the end is in fact better for consumers. There are some good things in there, and we think it's going to push some of the slime out of the financial business. By the way, this will end up being better for some of our local banks because the big banks are going to be burdened with a little more regulation. The smaller banks will have a little more flexibility.
You mean the ones that are still afloat?
That's for sure.
Joe Krier from Krier Wealth Management, always a pleasure here on the morning show.